Everyone's asking the same thing right now. Is the stock market on the edge of a total collapse? Again? Headlines are full of fear. Investors are selling, and the word recession is back in the spotlight. But here's what most people are missing. This market storm didn't come out of nowhere. There are real forces at play, and four of them point directly back to one name: Donald Trump. You might want to sit down for this one, because Warren Buffett may have just hinted at something that lines up perfectly with Trump's planned market crash. And no, that's not a conspiracy theory. It's a mix of four very real warning signs, each one backed by history, strategy, and some good old-fashioned political power plays. Now, Trump isn't calling it a crash, but if you read between the lines, what he's actually doing is setting the stage for something big. Today, I am going to break down each of these four factors, how they tie directly to Trump's comeback strategy, and most importantly, what you should be doing. So, here's where it starts. The Trade War 2.0. Let's rewind a bit, all the way back to 1930. There was this law passed in the U.S. called the Smoot-Hawley Tariff Act. Now, you're not alone if that name doesn't ring a bell. Most people haven't heard of it unless they're into economic history. But Warren Buffett? He's absolutely aware of what went down. Here's the short version. The U.S. government, trying to protect American farmers and workers during the early days of a recession, decided to slap heavy tariffs on imported goods. The idea was to make foreign products more expensive so people would buy American instead. Sounds like a simple fix, right? But what actually happened was the opposite. Other countries retaliated. One by one, they imposed their own tariffs on American goods. Global trade started to freeze. Instead of helping the economy, it ended up making things much, much worse. Businesses couldn't sell abroad, prices jumped, and international cooperation basically collapsed. What was already a rough recession spiraled into a full-blown catastrophe: the Great Depression. Now, here's the wild part. Between 1929 and 1932, the Dow Jones Industrial Average fell by nearly 90%. Think about that for a second. Imagine having $100,000 in the market and waking up with barely $10,000. Banks went under, credit dried up, and millions of jobs vanished. What started as a trade decision snowballed into a decade-long economic disaster. That's why Buffett always warns economic history might not repeat, but it definitely rhymes. And this trade war talk sounds very familiar. One of his most famous quotes is, "What he means is, when the economy gets tough, all the risky decisions and bad planning get exposed. And right now, that tide might be pulling back again." Fast forward to Trump's first term. He came in strong with his America First agenda and began placing tariffs on major trading partners: China, the European Union, Canada, and Mexico. His team framed it as a way to protect American jobs and industries. But what it really did was rattle supply chains and jack up prices for everyone. Now, here we are in 2025, and Trump is implementing massive tariffs again. Warren Buffett has always said that trade is a net positive for the world. He doesn't love deficits, sure, but cutting off partners and triggering retaliation? That's not smart economics, that's economic warfare.
How do you think tariffs will affect the economy?
I mean, tariffs are actually, we've had a lot of experience with them. They're an act of war to some degree.
How do you think tariffs will impact inflation?
Over time, they're a tax on goods. I mean, the tooth fairy doesn't pay them. I mean, and see, you always have to just, and then what? You always have to ask that question in economics. Always say, and then what?
So is there an answer for that when people say, inflation persists, consumer prices keep going up, when's the end in sight?
No, prices will be higher 10 years from now and 20 years from now and 30 years from now.
And what do you think about what's happening in Washington right now? About efforts to
I think
cut
it's Washington.
Yeah.
It's, technology changes things, all kinds of things, but Washington is Washington. And the problem with politics is that you tend to have to make tiny compromises as you go along.
But here's what's key. This isn't just about China anymore. If Trump continues this trade war, especially while inflation is still hanging around and global markets are already twitchy, we could be looking at serious ripple effects. Investors know it. The market knows it. And guess who else knows it? Buffett. He's been quietly shifting more capital into liquid cash, a hint that he sees potential instability in the US dollar and domestic market. He's also held onto Apple, which, not coincidentally, thrives in international markets, unless a trade war derails global demand. So, when do we know it's go time? When recession becomes inevitable? Well, Buffett says to watch the consumer. The American economy is 70% consumer spending. If confidence dips, savings rise, and credit tightens, it's not a gradual slowdown, it's a freight train coming. Now, that's just the first domino. Let's pivot to something even bigger: global power dynamics. Trump has made it clear he wants NATO to pay up or shut up. He's openly said the US shouldn't protect countries that don't pay their share. That sounds tough, but let's not ignore the consequences. What happens when the US steps back from global leadership? It creates a vacuum, and vacuums don't stay empty for long. That's where Russia, China, and other superpowers step in. Now, look at the current state of the world. Ukraine is still locked in a brutal war with Russia, and there's no end in sight. In fact, Russia has been doubling down, while China keeps one eye on Taiwan. And the Middle East, simmering again with rising tensions between Iran and Israel. If the US pulls back from NATO or weakens its commitment, even slightly, the probability of more conflict rises dramatically. Investors hate uncertainty, but they fear war, especially wars that spread across continents and pull in allies. Warren Buffett isn't a war investor, but he is a realist. He's invested in defense contractors before. Not because he loves war, but because he knows that instability drives money toward military logistics and cybersecurity. In fact, Berkshire Hathaway has held stakes in companies like General Dynamics, which manufactures tanks, submarines, and other defense systems. He also backed Raytheon Technologies, now RTX Corporation, a key supplier of advanced weapon systems and aerospace tech, especially during times of rising global tension. These are strategic beats. Buffett understands that when geopolitical conflicts flare up, defense budgets expand, and demand for security infrastructure surges. It's not about rooting for war. It's about recognizing how markets shift when the world becomes more dangerous, and positioning accordingly. He once said, "In the 20th century, we had 2 world wars, a dozen or so recessions, oil shocks, a flu pandemic, and the resignation of a disgraced president. Yet the Dow went from 66 to 11,497. Translation: crashes are survivable, but they're still painful, and avoiding the worst outcomes is better than enduring them. The more Trump plays hardball with NATO, the more the world leans toward multipolar conflict, and that is a massive stress test for markets. But this all could be because Trump is going for his secret plan, Trump's third big move. And this one's subtle, but maybe the most powerful of all. The theory? Trump wants a crash. Stay with me. If the market crashes, if the economy slows, and if job numbers dip, the Fed will have no choice but to cut interest rates aggressively. That's right, Trump may be trying to manufacture the exact conditions needed for cheap money. Trump's a businessman. Low rates are his best friend. They fuel real estate. They juice stock markets. They make debt cheap. And he hates when the Fed keeps them high. During his first term, he was constantly attacking Jerome Powell, even calling him an enemy of the state for raising rates. So, how do you force the Fed's hand? You break the economy. It's bold. It's risky. And it's not like the Fed would admit they're being pushed politically. But history shows, in times of crisis, the Fed acts fast. Remember March 2020? The Fed slashed rates to near zero in a matter of weeks. Now, here's the part people often miss. As interest rates go down, the cost of servicing U.S. government debt also drops, big time. Right now, the U.S. is paying over $1 trillion a year just in interest on the national debt. That's because rates are still elevated from the Fed's inflation battle. But if Trump forces a recession and rates drop from around 4.5% to, say, 2%, the Treasury could save hundreds of billions annually in interest payments. In effect, crashing the economy could ease the debt burden in the short term, even if it hurts the public in the process. And guess what? That could make room for tax cuts, stimulus, or other political goals, all wrapped in the idea of saving the economy. Warren Buffett, meanwhile, has been vocal about the risks of ultra-low rates. He once said they were like financial gravity being turned off. It distorts everything, from valuations to risk appetite. And when the party ends, it ends badly. Buffett's Berkshire Hathaway has been sitting on over $330 billion in cash. That's not a coincidence. He's waiting for things to break. Because when they do, he'll be the one buying at the bottom, not panicking at the top. So if Trump is crashing the market to lower rates, Buffett's not complaining. He's just watching, patiently. But there is more troublesome. Here's the piece that ties it all together. Trump's use of strategic chaos to create leverage, not just in U.S. policy, but also on the global stage. This isn't just a market crash. It's a calculated disruption that opens doors for bold moves both domestically and internationally. Trump thrives in chaos, always has. And the worse things look, economically, politically, even diplomatically, the more space he creates to demand change, force deals, and rewrite the rules. It gives him an excuse to pressure the Fed for lower rates, to strong-arm Congress into tax cuts or deregulation, and to push back against traditional alliances like NATO or multilateral trade agreements. In the U.S., this kind of environment gives Trump room to say, see, the system doesn't work without me. He can expand executive power under the banner of emergency reform, shift attention away from investigations or internal resistance, and reshape institutions that normally act as stabilizers. The crash becomes the justification. Globally, the message is even louder. America is going to do what's best for America. Deal with it. By creating volatility in markets and uncertainty in diplomatic commitments, Trump gains negotiation leverage with China, with Europe, with OPEC, with anyone. If the U.S. economy tanks under his leadership, he gets to dictate new terms and claim victory when recovery starts under his conditions. Warren Buffett, who has always praised the resilience of American institutions, sees this kind of chaos as dangerous because it shakes global confidence. He said many times that the American system works, and he's bet big on that system staying reliable. But if global investors, trade partners, and even American citizens start to believe that the rules can change overnight based on one man's strategy, that's when capital flees, currencies weaken, and volatility becomes the new normal. And that's the real risk here. This isn't about a crash being accidental. It's not incompetence. It's a tool, a pressure valve, a way to reset the game board, both in Washington and in global diplomacy, so Trump can deal from a position of crisis-driven strength. Buffett may not play that game, but he definitely recognizes when someone else is. And that's why, right now, he's sitting on cash, waiting for the chaos to play out. But here's the big question everyone's wondering about. If this crash is planned, and it's already started unfolding, how do you protect yourself? Or better yet, profit from it? Well, first, and this part matters, you can't play offense if you don't have any defense. Before you touch the market, before you chase any opportunity, you need one simple thing in place: an emergency fund. I am talking 3 to 6 months of expenses, safely tucked away. Once you've got that sorted, then you can start thinking about moves. Because when these 4 crash factors hit the system, panic selling, rate cuts, market corrections, political instability, the one thing you can count on is people will freak out. That's where your opportunity starts. Let's rewind to factor 1 for a second, Trump's trade war revival. And we're not talking about if it happens anymore. It's already started. Tariffs are back on the table and they're hitting hard. We're seeing supply chains tighten up just like they did a few years ago. Prices are creeping higher. Companies are adjusting forecasts downward. And the stock market? It's already showing signs of stress. But here's the secret. The drop isn't always justified by fundamentals. It's fear-based. It's short-term thinking. That's when great companies like Apple, Caterpillar, or even semiconductors tied to Asia go on sale, not because they're broken, but because the headlines are loud. You don't need to time it perfectly. You just need to buy consistently through the noise. That's where dollar-cost averaging comes in. If you set aside, say, $200 every 2 weeks to invest, regardless of what the market's doing, you end up smoothing out the highs and lows. When people panic and prices drop, you're buying more shares for less. Now, let's connect to factor 2, the NATO shakeup and rising war risks. Sounds terrifying, right? But not every industry loses during global tension. Defense contractors like RTX, Lockheed Martin, and Northrop Grumman tend to see huge boosts in spending during uncertainty. Now, back to factor 3, Trump forcing the Fed's hand to cut rates. Think about this. When interest rates drop, bond prices go up, borrowing becomes cheaper, and growth stocks often bounce back hard. So if you're holding cash and the market tanks, you're in the perfect position to buy into tech, real estate, or even crypto at discounts, right before a Fed pivot sends everything soaring. Want proof? Just look at March 2020. The Fed dropped rates to near zero, and within weeks, the S&P 500 roared back over 60%. Nasdaq tech stocks doubled. Even Bitcoin went from around $10,000 to around $60,000 in the next year. History doesn't repeat exactly, but when fear peaks and rates fall, upside tends to explode. Now, here's where Factor 4 kicks in: the strategic chaos play. When Trump disrupts institutions and global alliances to force leverage, it creates uncertainty across the board. That's where diversification becomes your shield. Let me explain. You don't know if this is going to be a correction, a bear market, or a full-blown collapse. No one knows. Not even Buffett, and he'd tell you the same. That's why you don't go all in on one asset class. You spread across the field. Put some money into solid dividend-paying stocks. Companies like Johnson & Johnson or Procter & Gamble that tend to weather storms and keep paying out. Invest some portion in bonds, especially short-term treasuries, because they hold up well when interest rates fall. Add a little crypto if you can stomach volatility. Look at Forex exposure, because if the dollar gets unstable, other currencies may climb. You're not betting on one winner. You're building an all-weather machine. So let Trump shake things up. Let the markets fall. Let the headlines scream recession. Because if you've got a plan, a strong foundation, and a long-term mindset, this so-called planned crash won't crush you. It'll position you. Buffett said it best. The best chance to deploy capital is when things are going down. Want to know Warren Buffett's crash-proof strongest bets for 2025? Click the video on screen to find out.